Your credit score just dropped, and you have no idea why. You check your bank account, money's there. You check your payment history, clean. Every payment made, every balance covered. You haven't applied for anything new. You haven't missed a single bill. By every measure you understand, you did everything right. And the score dropped anyway. Now here's what nobody prepares you for. That drop wasn't random. It wasn't a glitch. It wasn't identity theft. It wasn't the economy. It was a date. One specific date on the calendar that the bank never told you about. A date that quietly controls more of your credit score than your entire payment history combined. And most people have never once looked at it. And until you find it, understand it, and start working with it, your score will keep moving in ways that make no sense to you, no matter how responsible you are. Today, I'm going to show you exactly what that date is, why it carries that much power, and the precise sequence of moves that takes your score from wherever it is right now to the highest range it can reach. And I'm going to show you something else. Something that people with 800-plus scores are quietly doing wrong every single month. A mistake that looks like financial discipline but is actually costing them points they've already earned. Stay with me. This gets uncomfortable before it gets useful. Now, if breaking down the mechanics of money like this is the kind of conversation you want more of, and you should, hit the subscribe button right now. This channel goes places most financial content won't go. 2 seconds. Worth every one of them. Okay, let's get into it. Let's start with the belief that's costing most people their score right now. And it's a belief the banks are perfectly happy for you to keep holding. You believe the due date is the most important day in your financial life? And look, for avoiding fees and interest charges, that's true. Pay by the due date and you keep your money. Miss it and you pay penalties. Miss it twice and your report takes a hit that sticks for 7 years. So yes, the due date matters. But here's the thing most people have never been told. The due date has almost nothing to do with what gets reported to the credit bureaus. And what gets reported to the credit bureaus is what builds or destroys your score. Those are two completely different events, two completely different dates, and the gap between them is exactly where responsible borrowers quietly lose ground every single month without understanding why. So let me walk you through the actual timeline, because once you see how this really works, you'll wonder why no one ever laid it out for you before. Your credit card runs on a billing cycle, usually 30 days. Say yours runs from the 1st of the month to the 30th. During those 30 days, you use the card. Groceries, gas, dinner, subscriptions, whatever. Your balance climbs. And on the 30th, the last day of the cycle, the bank closes the books. It generates your statement. That PDF that shows up in your email. And the balance printed on that statement, that is the number the bank sends directly to Experian, TransUnion, and Equifax. That number gets locked into your credit report for the month. And now, your actual due date is usually 25 days after that statement closes. So think about what that means. You could carry a balance of $3,000 on the 30th. $3,000 gets reported to the bureaus. Then 3 weeks later, you pay the entire thing. On time, 0 interest, not a cent wasted, and the bank sends nothing to the bureaus about it, because they already sent the snapshot. The snapshot showed $3,000. And that number shapes your score for the entire month. You see, the credit scoring system doesn't run like a live camera. It runs like a photograph. And the photograph gets taken at the end of your billing cycle, right at the peak of your monthly spending, before you've had a single chance to pay it down. If you don't control when that photograph is taken, the bank takes it for you, and they take it at the worst possible moment. Now here's the fix, and it is far simpler than the problem makes it sound. You pay down your balance 2 to 3 days before the statement closing date. So when the cycle ends and the statement generates, it shows a balance of almost nothing. That near zero number is what gets sent to the bureaus. That's the photograph they receive. Then, because the statement just closed, you still have 25 days until the actual due date. And on that due date, you pay whatever small amount remained. Same card, same purchases, same payment habits. The only thing that changed is when you made the payment. But here's what you need to understand before you decide this is just worth a point or two. Because if you think the difference between $3,000 reported and $30 reported is minor, you are underestimating this number by a significant margin, and I need to show you exactly how much weight it actually carries. Pull up the FICO score breakdown. Payment history is the largest slice at 35%. Did you pay your bills on time? That's the biggest factor. Makes complete sense. But the second largest slice, coming in at 30%, is called amounts owed. And that category is almost entirely driven by one number: your credit utilization rate. Your current balance divided by your total available credit limit. And I need you to sit with what 30% actually means. Nearly a third of your entire credit score is based on how much of your available credit you're using right now. Right now, on this moment. Not your history, not your length of credit, not your mix of accounts. What you're carrying today. It outweighs how long you've been building credit. It outweighs every type of account you hold. You could have a spotless 10-year payment history, never missed a day, and 1 month of high utilization will pull that score down faster than almost anything else short of an actual missed payment. And here's the threshold that changes everything. 30%. Cross 30% utilization and the algorithm starts tagging you as a risk. Cross 50% and it treats you like a problem actively developing. Push close to 100%, maxed out, and the score drops hard and fast. And here's the part that blindsides people who think they're managing this well. That this doesn't just apply to your overall utilization across all your cards combined. It applies to every individual card on its own. You could have $50,000 in total available credit. And if one card, with a $500 limit, is sitting maxed out, your score still takes a hit. Because the algorithm reads that one account as a distress signal, regardless of everything else. One card. One threshold crossed. Score adjusts immediately. Now here's something that should actually change how you feel about all of this. Unlike a missed payment, which follows you for 7 years, utilization has no memory. The moment a new balance is reported, the previous one is erased. If you were at 90% utilization last month and your score dropped significantly, but you're at 5% this month, the score bounces back as if last month never existed. Clean slate, every single month. Which means you can engineer a serious score increase in 30 days or less if you know the exact numbers to hit and when to hit them. But here's where almost everyone gets this wrong. And this one catches people who genuinely think they're doing everything right. Everything we've covered so far points to one conclusion. Keep utilization low. Pay before the statement closes. Get that reported balance as close to zero as possible. So most people who understand this go all the way. They pay every card to zero before the statement date. Every card. Every month. And then they wonder why their score still isn't where it should be. Here is what's happening. Reporting zero across every card, month after month, actually signals something to the algorithm that quietly works against you. FICO is designed to measure how you manage debt. And if your report shows no balance on any card at any time, the model has no current data on how you actually handle repayment. From the algorithm's view, a person who never appears to use credit is slightly harder to evaluate than someone who uses it and manages it without breaking a sweat. You're not showing the behavior the scoring model is built to reward. The data from people in the 850 range shows they're reporting somewhere between 4 and 7% utilization. Small, active, consistent. They look like people who use credit and manage it like it's nothing. And there is a specific strategy built around that exact signal. It's called the all zero except one method. And if you are 60 days out from a mortgage, a car loan, or any major credit application, this is the move. Here's how it works. Say you have 5 credit cards. 2 to 3 days before each card's statement closing date, you pay 4 of them down to 0. On the 5th card, your primary card, or whichever has the highest limit, you pay it down so that when the statement closes, it reports a balance of roughly 1% of the limit. $10, $20, whatever gets you to around 1%. That small balance tells the algorithm, this person actively uses credit. The 0 balances on the other 4 say, and they're handling it completely effortlessly. That combination, one card active at 1%, and everything else at 0, produces the highest possible point score for the amounts owed category. Now here's the part that trips people up every single time they hear this. Reporting a balance is completely different from carrying a balance. When that card closes, showing a $20 balance, you have 25 days until the due date. You pay that $20 before the due date. 0 interest, 0 fees. You get the full score benefit of showing active credit usage. And you pay absolutely nothing for it. You are threading the needle between the closing date and the due date, and using both of them in your favor at the same time. Okay? So now you have the full strategy. Pay before the statement closes. Leave 1% on your primary card. Pay that off before the due date. But here is exactly where this falls apart for most people in practice. And the reason it falls apart is something almost everyone already has running in the background. Autopay. If you have autopay set to pay your statement balance, or even just the minimum, on the due date, it is doing precisely what it was designed to do. It's keeping you from being late. But it has 0 awareness of your statement closing date. It doesn't pay before the cycle ends. It pays after. Which means the balance that gets reported is whatever you were carrying all month. Not the number you could have engineered with 3 minutes of manual action. Autopay protects you from late payments. It does nothing for your utilization. To actually run this strategy, you have to step off autopilot at least once a month and take manual control. And here's exactly how to do it. Step 1 is finding the right date. You need the statement closing date for every card you own. This is different from the due date, and most apps deliberately bury it. Banks want your attention on the due date. That's where fees live. The closing date is usually in the statement section of your app. Open a past PDF statement and look for the phrase billing cycle ends or statement closing date. Write it down for every card you carry. Then set a recurring calendar reminder 2 to 3 days before each one. That 2 to 3 day buffer is important. Bank transfers can take a full day to clear and post. If you wait until the day before the closing date, the payment may not land in time. Step 2 is the payment itself. When that reminder fires, you log into your card and check the current balance. You say it's $800. You want to report $20 on this card. So you manually initiate a payment of $780 right then. You do it while you're looking at the screen. 2 days later, the statement closes. The system generates a bill showing a $20 balance. That $20 goes to the bureaus. Your utilization on this card, effectively 0. Step 3 is the cleanup. After the statement closes, you'll get an email notification. Open the statement. It should show a new balance of $20. Minimum payment, $20. You now have until the due date, usually 3 weeks out, to pay that $20. If autopay is set to cover the statement balance, it pulls that $20 automatically on the due date. But the first few times you run this process, check it manually. You've done something smart with your utilization. And the last thing you want is to accidentally miss that $20 payment and trade a score boost for a late payment that stays on your report for 7 years. Now, there is a version of this that crosses a line. And if you push past it, the bank doesn't just stop rewarding you. It closes your account entirely. Here's what that looks like. Your card has a $1,000 limit. You spend $1,000, pay it off mid-month, spend another $1,000, pay it off again, spend again. By the end of the month, you've run $3,000 through a $1,000 limit. You might think the bank appreciates the transaction volume. Their risk department sees something completely different. They gave you a $1,000 limit because that's the level of exposure they agreed to take on with you. When you cycle through that limit multiple times in a single billing period, you're forcing them to absorb transaction volume they never signed up for. To their fraud detection systems, this pattern looks like bust-out fraud, where a borrower cycles purchases repeatedly and then vanishes. The response is usually a frozen account pending a financial review, or a closed account with no warning. Either one does more damage to your score than high utilization ever would. So keep your monthly spending within your stated credit limit, even if you're paying it down early. And if you consistently hit your limit and find yourself needing to pay down mid-month just to keep using the card, the solution isn't a timing strategy. The solution is a credit limit increase. Call the issuer. Tell them you pay in full every month and you need more room for regular expenses. A higher limit makes all of this dramatically easier. If your limit is $20,000 and you spend $2,000, you're at 10% utilization without doing a single thing. You barely have to think about any of this. Now, here's something worth knowing about where the entire scoring system is heading, because the rules we've been working with are not permanent. Most lenders today use FICO 8, and FICO 8 is the snapshot model. It sees your current balance and forgets everything before it. But a newer model called FICO 10T works differently. FICO 10T uses trended data. Instead of looking at 1 month, it analyzes your balance history across the last 24 months. And it can tell the difference between someone who genuinely carries low balances all year and someone who carries high balances most of the month and scrambles to clean up before the statement closes. If you're authentically a low utilization person throughout the year, FICO 10T rewards you for that pattern. If you're living near your limit most of the month and only engineering a clean report on the closing date, FICO 10T sees the full picture. The good news is that FICO 10T adoption by lenders is still slow. For mortgages, auto loans, and most major credit decisions right now, FICO 8 is still the dominant model and the statement date strategy works fully. But the direction is clear. Long-term, consistently low utilization will always outperform short-term timing moves. The smartest play, use the closing date strategy when you need it most, in the 60 days before a major application, while building habits that keep utilization naturally low the rest of the year. And before the full protocol, there's one more move worth covering, because it's one of the fastest ways to accidentally spike your utilization. And most people do it believing they're being financially responsible. Closing old credit cards. You've got a card you haven't used in 2 years. No annual fee, no activity. It just sits there. It feels like clutter. So you call and close it. And here's what just happened to your utilization. Your utilization is calculated by dividing your total balances by your total available credit. Every open card contributes its limit to that total available credit. When you close a card, even one with a zero balance, you just removed its credit limit from your denominator. Your debt stayed the same. Your available credit just shrank. And your utilization percentage just climbed without you spending a single dollar. If that closed card carried a $10,000 limit, you could see a meaningful score drop within 30 days from a decision that had nothing to do with debt. So keep old cards open, even the ones you never use actively. Put a small recurring charge on each one, a streaming subscription, a single utility, and set those specific cards to auto-pay the full balance every month. Then leave them completely alone. They're not clutter, they're ballast. They're what keeps your utilization stable while you use your primary cards freely. Let's close the loop on the full protocol, because everything we've covered today fits into one clean sequence, and once you have it, you own it. Step 1. Stop treating the due date as the only date that matters. Find your statement closing date for every card you own. Look in the statement section of your app or open a past PDF bill. Set a calendar reminder 2 to 3 days before each one. Recurring, every month. Step 2. Know your utilization targets. Under 30% is the floor of decent. Under 10% is where excellent scores live. 4 to 7%, with one card showing a small active balance, is where the highest scores are consistently found. Step 3. 2 to 3 days before each closing date, log in and manually pay down your balance. If you're running the all zero except one strategy, you pay every card to zero except your primary, and pay that one down to roughly 1% of its limit. Do this manually. It takes 3 minutes. Don't leave it to autopay. Step 4. Let the statements close. The bank sends those low balances to the bureaus. Your report reflects someone who uses credit and manages it without effort. Step 5. Pay the remaining small balances before the actual due date. AutoPay handles this part cleanly, because by now the balance is small enough that timing doesn't matter as long as it clears before the due date. Zero interest, zero fees. Full score benefit. You don't need to run this at maximum intensity every single month. That level of management is for one specific window, the 60 days before a major credit application. A mortgage, an auto loan, a business line of credit. When you need your score as high as possible, as fast as possible, this is the lever you pull. The rest of the year, keep utilization generally under 20%. Let AutoPay handle payments, and let the score do what it does. It will fluctuate. That's normal. The point isn't to watch it every week. The point is knowing you have a reliable, tested tool you can pick up on demand and use it precisely when the stakes are highest. The credit system runs on rules. Most people only ever learn the rules that protect the bank. Fees, interest rates, minimum payments. The rules about reporting dates, snapshot timing, and data control are just as real. And once you know them, they work entirely in your favor. You've been living on the bank's schedule, paying when they remind you, letting the snapshot happen whenever the billing cycle decides. I'm wondering why your score doesn't reflect the responsible borrower you actually are. Now you know the schedule. Now you run it. Pay before the photograph is taken. Control what the bureaus see. And stop letting the algorithm define your creditworthiness when you've already done the work to deserve better. Try this with one card this month. Find the closing date. Pay it down 2 days early. Leave 1% on it. Then open your credit monitoring app when the new report comes in. When you see the number move, and it will move, come back and drop a comment with how many points you picked up. That data helps every single person watching this video. And if this breakdown gave you something real today, Subscribe and ring the notification bell right now so you don't miss what's coming next. We go this deep every single week. Subscribe, ring the bell, and I'll see you in the next one.